Hey, Trisha here. So, do you want to save more on taxes this year? I do. In today's video, we're going to talk about the 5 things that you need to do within the next month and a half that are essential to lowering the taxes you're going to pay. The first one's going to be to definitely make sure that if your company has a 401k match, that you're putting in at a minimum whatever that amount is. So that's your number one thing to do is if you have a company 401k plan that has any kind of match, then you definitely want to do that because the amount that you put into your 401k, you will be able to reduce your taxable earnings by that amount. So this year, if that amount is, I don't exactly know offhand, I'll put it on the screen. Um, Say it's 26,000 per person because you're over 55, say. Well, if you have a match, you definitely want to put in up to the match. But if you're in a very high tax bracket, it might even be beneficial to try to put in the entire $26,000 into your 401k. That way, at the end of the year, say you made $126,000, well, that 26 reduces your taxable earnings by that total amount. So you'd only be paying taxes on $100,000. So to me, that's your number one thing that you definitely need to do. And you don't have to do it month by month. If you are already kind of late in determining that, you can change your contribution limit mid-year. So you might want to look into that, talk to your HR if you have an HR, and that's a really good solution for lowering your taxable earnings. So if you're somebody who's 25 and you're making a decent amount of money and you can contribute $500 a month into your Roth, that's $6,000 at the end of the year into your Roth that you know you have now for the next 30 years to grow. So that would be my recommendation. Number one is to contribute to your 401k, or if you cannot, or there's no benefit to that, then contribute to your Roth. But the number one way of reducing your taxable income is by contributing to either your 401k, or our next suggestion is to contribute to your HSA. Now, the other stipulation with the HSA is you have to be on a high deductible plan. And most people are not. But if you happen to be one of those that do have a high deductible plan, then you're able to contribute into your HSA. And that also reduces your taxable earnings. And the nice thing about that one is that you put that money in before you pay taxes on it, and it grows for however long, maybe 20, 30 years, hopefully. And then when you're ready to start using it, it's grown quite a bit tax free. And you can use that money for any justified, legitimate medical expense. So that one's an even better account, but it does require that you have an HDHP plan. And most people choose not to have that one because it's a high out of pocket if in fact you ever need medical. So that would be the number two thing that I would focus on before the end of the year. Usually at the end of the year, most people take their profits. And so some stocks tend to fall. And so if you had one that was possibly not doing the greatest, then you might, if you needed to, take a loss on that so that you can reduce the amount of taxes that you're going to pay. So an example on that might be, say I bought Visa, and but say for example, I paid 200 and I bought $10,000 worth. And so now my $10,000 is only worth $8,000 because the price has fallen. So that $2,000 loss, if I sold my stock now, I would be able to report that loss on my taxes. Tax loss harvesting is a time when you can sell something that you purchased at a higher price, that you sell it at a lower price, and then you take that negative amount and use it to lower your taxable earnings. So that would be the third thing that I would recommend. So another thing that you can think about doing is giving to a charitable organization. You can give goods, you can give stock, you can give money. Some of those, they're treated differently. So some of those might help you in reducing your taxable earnings. I would say my number 5 thing to do is contribute to your child, your grandchildren, if you have them and they have taxable earnings, that maybe you can gift them some money. You can't write it off on your taxes, but it may help them and it might lower their tax situation. For example, like my daughter's in college and she's working, but she doesn't make that much money, but she makes, enough to where she might have to pay a little bit in taxes. But if she contributes to her IRA, then it'll reduce her enough so that she doesn't have to pay any taxes. So that's something to consider. If you're in a position where you can do that and you have children or grandchildren that could benefit at this time, that might be the right thing to do, for you and your family at this moment. So these are 5 things that I've found that will help me in lowering my tax exposure this year. And I think everybody, is things are a lot more expensive right now. Things are, our insurances are higher, our food is higher, our gas is higher. So any way that we can lower the amount of taxes that we are going to be having to pay, I think that's a win. I'm just trying to say, let's look into it, let's research it, let's look at our options, and hopefully they benefit us. And I know, key to my retirement was contributing to my 401k. You had to do that first, and then you spent what was left over. So, all right, these are the 5 essential things that you need to do before the end of the year. Get on it. It's already the end of November. And so, we need to do that quickly. All right, then. Talk to you soon. Subscribe if you haven't, and we'll see you next week. I'm free.